All right, what is up, tycoons? What's up, traders? Super excited for today's video. We're going to cover natural gas and go over some of the natural gas news. All right, now it's no surprise that since natural gas has been on a little bit of a rally, okay, the past week or so, we're starting to see some bullish headlines, right? So we're going to go over some news, and then like always, I'm going to give you guys a nice detailed technical analysis on the things that I'm looking at personally across the spot prices of natural gas. So we're going to go over the natural gas futures chart today as well, and then go over UNG and Boyle. So make sure to stay tuned to the end of the video so that way you don't miss any of the TA, or if you don't care too much about the news and you just want to skip past that and go straight into the technical analysis, all you got to do is fast forward a little bit to around the second half of the video. With that being said, smash the like button, subscribe to the channel if you guys are new. I'm covering natural gas every single week, so it'll be a really good place to get some constant updates on it. So let's start off here with the first headline, right? EOG Resources strikes upbeat tune on natural gas and oil volumes. All right, EOG Resources is a multi-basin exploration and production firm. They said its strong fourth quarter and full year 2022 results were powered by robust natural gas and oil demand, price spikes, and steady production activity. Okay, and the next headline here is that the natural gas forecast. The technicals suggest higher prices, right? The next target zone for natural gas is identified with past support and resistance levels, providing important context. And right here, they're saying that the next target zone is going to be about 297 to 306. That's where both support and resistance was seen in the past. That price zone is then followed by a more significant price zone from around 3.42 to 3.54. That zone is where there was a swing low and high in the past, and the top of the range completes a 23.6% Fibonacci retracement of the internal downtrend. In addition, the 50-day EMA is currently at 346. In Fibonacci analysis, the 23.6 retracement level is considered the minimum retracement to be incurred. Now, I tend to go over the fibs a lot in my videos as well, so I like that this person, Bruce Powers here, is actually using the fibs. That's pretty cool to see him doing. We'll take a look at the next one, and we can see the headline is that technical factors, March chills, seen lifting natural gas price futures in early trading, right? And so in terms of technical factors, prices could be primed for a robust run higher, potentially riding the tailwind of building momentum from a 48.4 cents rise from Wednesday's intraday low. Natural gas also crossed a key technical inflection point at the 20-day moving average. It's possible that shorts may finally be taking profits, right? And that's something that I've kind of been discussing a lot too, is you have to keep in mind that shorts have been making a killing as of recently, shorting natural gas, okay? And a lot of this bounce here could potentially, there is the potential that there's a lot of shorts actually just taking profits. And, you know, to take profit on those short positions, you actually have to buy in, right? And so that could be creating a little bit of buying pressure, pushing things up higher. Right now, while natural gas appears fairly priced from a fundamental perspective, a technically driven jump higher may occur near term. But if bulls can get the job done to start the week, the door will be open for a run back toward even above $3. So it's still early in the week. We're going to see what bulls can do, and you know, if they can get some more shorts to close, potentially even try to cause a short squeeze here later. But if they cannot, more congestion and or a test of the $2 neighborhood by the April contract is still possible near term. All right. And we look at our next article here. We're talking about how U.S. natural gas futures hit a 1 month high. All right. They hit that high on Monday on forecasts for colder weather next week and a rise in LNG exports. Another reason for the sharp uptick in natural gas prices is the U.S. average gas output. All right, these conditions were brought in on part due to freezing temperatures that took oil and gas wells offline in some of the areas of the United States, and partly due to falling natural gas prices so far in 2023 that spooked energy firms into slashing the number of active drilling rigs. Weather forecasters are indicating that the current cold snap could stick around through the middle of next month, although they have acknowledged we may see milder weather over the next few days. Now, we have a little bit of international news here. All right, Kazakhstan could suspend natural gas exports next winter. That's basically what this is covering right here. And they could do that, right, to prevent a domestic gas supply crisis. Kazakhstan, the biggest oil producer in Central Asia, exports natural gas to Russia and China, right? Their natural gas transportation infrastructure provides international transit and sells gas on the domestic and foreign markets. There will be no deficit of gas in Kazakhstan next winter, but only if there are no exports. Meanwhile, crude oil from Kazakhstan started flowing via the Russian pipeline network to Poland for further delivery to Germany, Russian pipeline monopoly operator Transneft said on Monday. Now, Kazakhstan expects a deficit and it will cut gas exports to zero by 2025, the energy minister said. And then we will have to think where to get gas to meet the growing demand in addition to our own production. If we take a look at the next one, this is going to be our last slide right here. And then we start getting into the technical analysis. Okay, so this is my natural gas futures monthly chart. And you can see the headline here is that monthly candlestick pattern is likely to complete a bullish hammer pattern. It's also interesting to note that since February is almost over, and this is the last day of February at the time of this recording, that the monthly candlestick pattern for natural gas is likely to complete a bullish hammer pattern. If correct, then starting next month, a breakout above the February high will provide a monthly bullish signal. Nevertheless, given the wide monthly range in February of 34.8% to date, natural gas can spend some time correcting and consolidating below the monthly high. This is true after a monthly bullish breakout and before it breaks higher if it is to do so. So we're going to start getting into some of the technicals, the key levels, go over the things I'm looking at. Remember, guys, this isn't financial advice, okay? I'm just presenting you guys some news and some data. These charts are nothing but pure data, and I'm just going to give you my opinion on some of the levels to pay attention to, as well as some of the different technical indicators. Now, as I mentioned here, we're going to start off on the natural gas futures monthly chart. Now, what I really like about this is that we've got a clear demand zone established here, right, on our futures chart. We can see that plenty of times in the past, we've come down into this range and pushed higher. Each time we've come down and tested this range, we've been able to push higher, and we recently just wicked down below and tested this range again. Okay, so that's a good sign. This right here is that reversal hammer candlestick pattern that they're speaking of right here. And so what you're seeing is that price, all right, on this monthly candle drove all the way down to this monthly demand zone, but there was so much demand, there were so many buyers that it quickly pushed price back up, and it's very close to its opening price, right? So that ended up forming this hammer candle. And as long as natural gas doesn't puke like 20% today, okay, then we're going to end up getting this hammer candle to play out and close on for the month of February. Now, just like we have this demand zone down here, there are two overhead supply zones to really pay attention to. All right. Now, supply and demand zones are very similar to support and resistance. I've got a whole tutorial on them, but really those are going to be some of the key areas where you want to actually make your trading. All right. Versus the dead zone, right? Which is kind of like the area in between. A lot of time I like to call this no man's land. You want to enter in the areas of imbalance where prices previously been pushed down or pushed higher. And those are going to be some of the key areas to really try to make your trades. Okay, but we can see here, you know, this was a prior supply zone. We started pushing down multiple times in the past. We broke through here and established a new supply zone up above, and we came over and consolidated in this range over here before coming down and testing this level as well. So prior supply zones are going to turn into new demand zones once you come back down and retest them. So we are testing this as a demand zone. But, you know, if we just consolidate and push back lower, the supply imbalance is still going to be there as we hit, came up from the demand zone into the supply, we could push down. So, when it comes to the futures chart, these are two zones that I'm really paying attention to see how price action responds in them. If we take a look here, this is the 4-hour chart. This is the natural gas futures, and you can see that demand zone that I was speaking of, right? We zoomed in, and so you have to keep in mind, right? Typically a demand zone is where you're looking to potentially go long, and then the supply zones are potentially where you're looking to go short, okay? So, we got the entry here into demand. All right, and we had a very strong reaction. That demand was present and pushed us up higher into our supply zone, but we're forming now a little bit of a bearish chart pattern, and this pattern is going to be known as a rising wedge. So if you take a look, we're really just zigzagging in between these two channels, these two trend lines, and if we do happen to get a breakdown below of this bottom trend line here, there is a potential that we could get a rising wedge to play out, and that would take natural gas futures anywhere from about 160 to 180 if that pattern plays out. Now, there's multiple ways that this could go. Okay, this pattern isn't confirmed. It's just something that forming that we're taking a look at. You know, this thing could just consolidate sideways and break the structure, right? Or we could continue to push higher and break the structure. We could get a look below and fail and actually enter back into the range. And the reason that's important is because that's going to show that bears were actually presented the opportunity on the breakout, and rather than taking control and pushing price lower, they actually looked below and failed, and bulls actually demonstrated that they were stronger in the market, and that when given the opportunity, bears weren't able to push price lower, and it could do that. And then of course we could actually get the pattern to play out and just do a normal rising wedge. So we have to see how things are going to develop. All right. But that's definitely something that I'm looking at when it comes to the natural gas futures chart. Now, if we look here, this is the spot price of natural gas. And what we're doing is we're actually going over the MACD as well as the RSI and, some of our previous lows, right? So this low right here, the 2.2 is right around the November of 2020 lows. And this low right here of 187 is right around the February 2020 lows. Okay. So we have tested that level. If you look, we got a nice bounce right around that 2.2 area. All right. And we've actually broken through there, and we're trading just below it right now, right around 207 at the time of this recording. But let's go over some of the key signals that you guys can start using and learning about to really help you understand some of the price action and possibly even predict some good entry or exit prices, right? So if you take a look, we have a lot of arrows on the chart, right? Clearly, we're making higher highs right here and going up. But if you look at your RSI, remember, this is the relative strength index. It's going to measure the relative strength at the given prices. So we actually see, even though we're making higher highs on the price, we're making lower highs on the relative strength index. That's a bearish divergence. It's an indicator you may see some downward activity. And sure enough, we do end up getting a nice move to the downside afterwards. Now, you can combine this with MACD signals as well. So the red line is going to be the one you want to pay attention to. And when it crosses below that blue line, that's going to be known as an exit signal. So you can see that right around the same exact time that we get bearish divergence, we end up getting a MACD exit signal. And so we really actually have two indicators telling us we could see some downwards activity. And then sure enough, we do get that downside move. Now, this works to the upside as well with bullish divergence. So if you take a look, we have lower lows at this point. All right, clearly heading downward, making lower lows, but the relative strength index is making higher lows. So in this case, it's a bullish divergence. You also get a nice MACD crossover to the upside here, and we can see we get some upwards pressure. And these divergences, along with MACD signals, have occurred many, many times throughout the history, and it's been respecting them and following them pretty well, okay? Now, you can never predict if it's going to be a small move or a big move based off these divergences, but if we take a look, there's a couple key divergences that we need to pay attention to right now. So if you take a look, we have a low right here, and then obviously we have some lower lows over here. So it's definitely been in a downtrend, right? Creating lower lows. But at this point, we have a low on our RSI, and then we actually have a higher low right here, okay, where we got a bounce off of our initial bullish divergence, and we're coming down and retesting this bullish divergence trend line again. So if you're bullish on natural gas, you want to see the spot price bounce off of this trend line and continue to head in an upwards direction. Okay, we also got a MACD crossover over here as well, and it curled up to the upside. So, we are seeing some good signals, okay, but we're not necessarily getting all of the follow through that we want. All right, we're going to see how things play out and how things develop. But a key level we need to pay attention to is going to be this initial bearish divergence trend line. Okay, if we come up here, test this trend line and reject it, that's going to be not exactly what bulls are looking for. Rather, you're going to look for it to come up and break out and flip that trend line from resistance to support and continue to head higher. So, here's where that initial bearish divergence happened, where we're creating those higher highs. And then we have the lower high here. And that trend line has not been retested after this initial drop off that we've had. So it's going to be really important too, once we come up to this level, if we come up to this level, for bulls to break out past it. Otherwise, it could be a rejection point and send prices back down lower. All right. Now the next one we're looking at is UNG's daily ABC structure. And after we hit this C wave here, I did actually grab some more UNG and really just, I'm just being patient with things right now, guys. I'm not trying to rush into anything. Remember, it's not financial advice. Just because I'm buying something or people in the comment section are buying something, that doesn't mean that you should always follow. You have to set up your own risk management and determine what your risk profile is. But that being said, we're looking at some of the same signals here. Okay, we have the MACD and RSI signals. You can see the divergences, okay, combined with the MACD signals have been playing out pretty well. Currently, we have a little bit of a weaker bullish divergence, okay? So we have a low here, we have an equal low, and then we've started to bounce, right? But at this point, we have a low, and then we actually have a much lower low. So when you're making the equal lows on the RSI while creating lower lows, that's going to be a slight bullish divergence and an indicator you may see some bullish activity. And sure enough, we are starting to bounce a little bit on the RSI. We did get a nice strong bounce here as of recently, but 857 has been a pretty strong resistance level, as well as 904. Those are going to be some, key levels to watch out for right now. Above there, we're going to be looking at 1031 and 1167. But back to this ABC structure, right? So the way that I got this 752 price target is by going on the 1.0 extension of your A to B wave, right? So you have the move down. We got a nice healthy retracement. Okay. And then once that retracement happens, the C wave is going to be a 1.0 extension of your A to B. And that was our 752 target. That's where we actually got that from. After cracking our 822 support level, I said 752 was going to be my next target on there. Now we have the fib rejection levels on here multiple times. I'll kind of give a brief synopsis of how to use those, but they help you identify trend continuation because nothing moves in a straight line up or a straight line down. Rather, you get a move down retracement continuation lower or a move up retracement continuation higher. That's how you spot trend continuation, right? So you can see we moved down, we retraced up to the 61.8, and then we continued heading lower. The three levels that I like to look at are the 61.8, the 50%, and the 38.2. These are the three most common and well-respected retracement levels when it comes to using the fibs. And each time we've retraced to our major retracement levels, we ended up rejecting, right? Over here, we rejected the 50. Over here, we rejected the 61.8. And we've just been in a downwards move, really just demonstrating symptoms of a falling knife and not really getting any strong bounces. We are starting to bounce a little bit. And if we were to get a retracement up to our 38.2% retracement level, that's going to be about 12.7. Now, if you take a look here, this is the same chart, but just zoomed in a little bit more. And so our recent lows were 715 underneath that 752 level on UNG. Below there, I do have some price targets, but we're not really there at those price targets right now. What I really just wanted to show is that if we were to get a 61.8% retracement just from the recent lows, that's a 126 move on just UNG, right? And Boyle is the leveraged kind of version of UNG. So you can imagine what the returns possibly could be on Boyle if you were to get a 61.8% retracement level. Now, there's lots of work to be done before then, okay? We have to break through all of these resistance levels, right? And then we'd have to break through the 38.2 as well as the 50% retracement level. But ultimately, 1615, 1443, and 12.70 are going to be the three fib targets as of now on UNG. If we take a look at the next chart, this is Boyle, right, with some of the daily patterns and the MACD signals, okay? And we can see, there were a couple head and shoulders that we did have on here, right? We had a left shoulder here, head, right shoulder, all right, left shoulder, head, right shoulder here. Both of those head and shoulders played out pretty nicely. These are going to be the fib targets, and very similar to the others, we're getting some of the same signals on our RSI as well as our MACD, okay, when it comes to Boyle. Right, we're getting those slight bullish divergences. We're seeing a couple entry signals on Boyle, on the MACD, but we're not just seeing, those entry signals. We're really not getting the follow through on the price action from those signals. Okay, so, we've actually been lagging, continuing to drop, or really just consolidating, moving sideways. Now, this is it zoomed in a little bit more. And so the key levels right now below our major Fibonacci retracement levels, which those three are going to be 28.18, 23.65, and 19.12. The major levels that we have to break through are going to be 1461, 795, and if we continue heading lower, all right, we could come down to the 3.2 area, right? 3.29, 3.21, somewhere within that range. Now, currently, Boyle is setting up an inverse head and shoulders. Now, just because it's setting up doesn't mean it's going to play out and doesn't mean it could, end up forming altogether. But currently at the moment, we do have a left shoulder, we do have a head, and if we do pull back a little bit and find some support, okay, we could end up establishing a right shoulder, and ultimately that inverse head and shoulders could take us up here to about the $10 to $11 range on Boyle. Now, Boyle and UNG both hit all-time lows here recently. So, we're really seeing some historic prices when it comes to these two. And I know a lot of people are super bullish on this stuff just because of how cheap those ETFs are. But you have to remember, use some risk management. Okay, just because something's hitting all-time lows doesn't mean it's guaranteed to automatically rebound. It may take longer than effect. And, there is some decay involved when it comes to Boyle and UNG. There is a little bit of a decay factor. All right. So that's going to be it for today's video. Hopefully you enjoyed it. If you did, smash that like button and subscribe to the channel. I do videos like this on natural gas every single week. So you can look forward to getting, some nice consistent updates. Okay.